Welcome to the Smart Investing Podcast, brought to you by Money and Me, an investor education and awareness initiative by PGIM India Mutual Fund.
All right, let's go. It's time to open up all of your investor curious minds to a brand new concept. You know, sometimes it's more important to know what not to do than to know what to do. What is that? Knowledgeception? I don't know. Welcome to PGIM India Mutual Fund presents Smart Investing, everybody. Ahalya here, keeping you company. As always, for just a jiffy before Ravi and Lisa take over the podcast. Now, just to decipher that thought in the beginning, it's not that complicated, and it's a philosophy that we all very unknowingly use and apply to our lives. Often, when making a decision, we don't make the decision by knowing exactly what we want. We narrow down on it by acknowledging and recognizing what we don't want at all. And when it comes to investing, it can be difficult. And often the reason many people don't ever get started is because we get overwhelmed. But I've always found that in life and in investing, it's easier to get started when you know what to avoid. So that's going to be the topic of today's conversation: investing mistakes to avoid in your investor journey. Perhaps one of the most useful conversations you could stumble upon. So I would urge you to stick with us and stay through the entire podcast. Ravi, Lisa, over to you.
Thanks, Ahalya. There's this famous quote by legendary investor Warren Buffett. The first rule of an investment is don't lose your money. And the second rule is don't forget the first rule. At this time of exuberance and excesses, this quote is a good reminder that losing less money is also equally important. Let me explain this with a simple example. If you have 100 rupees today and it becomes 50, you will have to earn a return of 100% to get back to your initial capital. So there's so much focus today on how to invest rightly. We often forget to talk about the mistakes that we may be making in the first place. So in today's discussion, we will talk about the 6 common mistakes that investors can avoid while investing. Welcome, Lisa.
Hi, Ravi. Talking about mistakes that people can make is a very important discussion where investing is concerned.
Yeah, and that reminds me the first investing mistake that I personally did when I started my career. So actually, I invested in an endowment plan thinking that it is an investment, and obviously later regretted investing in it. So what is your investing mistake that you might have done early in your career? Could you share that?
Yeah, Ravi. So, we all make mistakes in investing, right? I know I have in my early days, and my own top mistake was perhaps to start investing later than I should have. I was too busy spending the money, which comes easy.
What would you say, which are the top investing mistakes that investors today are making, especially while picking a fund to invest in?
One of the other mistakes, which I still see is highly prevalent among investors and perhaps could easily be one of the top mistakes, is looking only at past returns to choose funds. Actually, many investors are still investing in mutual fund schemes based on the past 1 year return. This is how several, small and mid-cap funds saw investments increasing over the past 2-3 years. And it's how many sector and thematic funds are sold today, right? And those are the sectors which have actually performed well only in the recent past.
Yes, you're right. And, more than 50% of the net inflows in equity funds have come in the sector and thematic funds in the last 6 months. So what would you say is the correct way of looking at returns when you're investing?
Yeah, so it's easy to select funds based on recent returns. I suppose that's why it happens. They are real, they are visible from not so long ago, and hence kind of fresh in our minds. However, the golden rule in MF investing, what we have seen is that no one fund is going to be the top performer year after year. Just like the equity market has cycles, individual funds also go through ups and downs when compared, within their peer set. So if you pick each new fund based on the last 1 year return, you are buying the past, not the future. You should instead focus on consistency of return, the portfolio dynamics, the fund manager's track record, and the consistency of the investment process that the scheme and the fund house is following. Also, you need to not always consider the top performing scheme. Even if you're looking at the longer term, 3, 5, 10-year return, you need to target funds that consistently show up in the top, say 25% or 30% of their category, not really only the top performer. And when I say consistently, I mean over the last 5-10-year return period, which you can study for the past few years. So lastly, one more point is that while we are saying that past returns are not the only barometer, we do need to check these long-term returns, like I said, 3, 5, 10-year periods. There are many new fund offers in the market and the track record is missing because, of course, they are new. I'd say you need to do a check on the consistency of returns of existing funds, else you don't know where you are investing. But be careful of relying only on the point-to-point returns in the recent, say, 1 year or recent past.
Yes, absolutely. Past returns are for past investors and future returns are for today's investors. Now, the problem is that we get too excited when we see a large outperformance of funds, just like we panic when we see a fall in returns. So, can emotions make or break your investment discipline?
Yes, always. We are emotional beings. Letting emotions guide your fund decision, however, is a big no. It's not just relevant to the fund choices we make as you're talking, but also how we guide our overall investments. So, for example, SIPs are a big way to invest in mutual funds now. There is also a facility which allows you to pause your SIPs, right? Now, in a market fall, if you panic and press the pause button on SIPs, thinking that you will stay out of the correction and not be impacted, that's really a big mistake. Because ideally your SIPs must continue through a market fall to give you the benefit of lower NAVs and higher number of units. Similarly, increasing your investments in the latest trending fund category at the moment, as we are saying, sector funds, just to partake in the herd euphoria, that's an emotional choice. It's not an objective investment decision. Best to keep emotions aside. Invest based on objective reasoning. Emotions will make you react and make decisions which can work against you also in the long run.
Yes, now there's so much information overload out there in the market. Investors are exposed to so much information. I think a lot of investors are trying to, time the market based on news or events. But in reality, facilities like systematic investment plan, like you said, or even systematic transfer plan, there's no need to actually time the market. These are just autopilot facilities which are available for investors, right?
Yeah, so, honestly, Ravi, the problem with trying to time the market is that you are unlikely to get it right in the first place. And, even if you're lucky once, you may not be able to tell when the tide is turning next. So you exit your equity mutual funds thinking valuations are too expensive. This is actually something that investor did just before the COVID crash in March 2020. Those who did were very happy initially when markets crashed, but practically no one was able to foretell how quickly the market bounced back, right? And we have witnessed the most relentless rally since then. Were those who timed and exited able to come back just as quickly? Again, it's unlikely. For regular investments, there is, like you said, the SIP facility, which lets you invest some amount every month. Hence, it doesn't matter whether the near-term market outlook is up or down. You keep accumulating units for the long term. This works as long as the long-term outlook of the economy and consequently, of course, the equity market is positive. But what should you do if you have a lump sum to invest? Well, you can stagger it over the next 6 to 8 months in equal lots. Again, by doing that, you're avoiding timing the market. Essentially, even traders whose entire profession is about market timing get it wrong. So really, it's a pointless exercise. For long-term wealth creation, regular systematic investing is a much more reliable way to move forward.
Yes, you're right. And in fact, there's a study done by Morningstar last year, which is for across all the equity categories of funds over a 10-year period from 2013 to 23, and the study shows that half of the fund's outperformance was due to 4 or fewer months. So if you exit during those 4 months, you are actually missing out on the return. So I think investors should just stay invested and let the compounding work its magic. And of course, they should diversify across all investing styles. So, what are your views on diversification of funds?
Yeah, exactly. So diversification is an important discussion. Let's begin by understanding what diversification really means. It means don't put all your eggs in one basket. Why not? Because if you drop the basket, you're in danger of losing or breaking all your eggs, right? Now translate this in terms of mutual funds. It means don't just invest in one type of fund, like say only equity or only large cap equity funds or only infrastructure themed equity funds. It also means don't invest in schemes of only one fund house. Lastly, it means don't invest in schemes of only one type of investment style, now be it any asset, equity or debt. So essentially, to have an optimally diversified portfolio, you need stocks and hence funds across the market capitalization spectrum, across assets, across investment styles and fund houses. Then you are diversifying risk of failure or non-performance in any one pocket of the market or any one type of investment style or even fund house failure. But honestly, often the problem is not under diversification. It is over diversification. Individual investors carry way too many funds in their portfolio. They lap up a different fund every year in a bid to get the latest best performing fund, as we spoke, or investors are following all the new fund offers and choose to get a little of each that gets launched. Fact of the matter is, each mutual fund scheme will have at least 30 to 50 stocks, if not more. And when you have 10 equity schemes in your portfolio, you will end up with holding similar stocks, which would be kind of overlapping. Then you might as well have invested in the, BSE 500 or Nifty 500. You don't need so many different stocks in your portfolio. Many investors have 15, 20 different funds, and that's really not adding any incremental value, to your overall returns. It's best to diversify across with one fund in each type of investment style or market capitalization, whatever suits you more. And of course, you have to diversify across assets based on your needs and goals.
Yes, you're right. In fact, investors should check what's under the hood. They should read the investment objective of the fund while investing. So there's a fine line between, over diversification and under diversification. So they have to strike the right balance when designing their portfolio, which brings us to a last discussion. And I think we discussed this in our last episode also. When you are investing, you should actually invest as per your goals and risk appetite. So what's your view on this?
Yeah, Ravi, so much of what we are talking about is all connected. If you are investing without any goals and just chasing return, you will end up firstly wanting the best performing fund every year. This we now know is a mistake to begin with. Then you will end up with too many schemes and over diversifying, which also, as we discussed, is a mistake. Hence, it's best to get into your investing journey with some goals. It's possible you may not have, specific goals like child's education or vacation planning or buying a house even. So your goal can be a simple long-term wealth creation. Here as well, ascertain what that wealth creation is for. Is it for retirement? Is it that you would like to start your own venture in say 10 years? And then ascertain what kind of growth you need in your investments. Working backwards with goals helps you pick the right assets and the right asset combinations. If you do have a near-term goal of accumulating some amount, say as a down payment for buying a house, then you have to stay away from investing in equity with that amount. You need to find a safer, more stable return asset for that amount of your goal. So if you were to write down all your goals, and let's say you have 4 to 5 different goals that you can foresee today, you then need to write down an approximate value for each goal, and then you match the goal with the accurate asset. equity, debt, or a combination of assets. Lastly, work backwards with the expected return from each asset to determine how much you need to invest in which type of fund for which goal. We have actually spoken about this in detail in the previous podcast on goal-based investing.
Yes, Lisa. I would urge all our listeners to, in fact, go through all our previous podcasts, which are packed with a lot of investment insights on a host of topics. And before we wrap up, here are the 6 investing mistakes one should avoid. So I'll start with the first one. Avoid investing after only looking at the recent top performance. So the performance may not sustain going ahead. So it's best to look at 3, 5 or 10-year rolling returns. The second mistake that people often do is they let their fear or greed drive their investment decisions. So, diversify and don't let your emotions come into play. The third mistake is don't wait for the right time to invest. You can start as soon as you can. So you have facilities like SIP or STP in case if you want to invest lump sum. So don't wait for the right time. And the fourth mistake is don't try to predict the market. No one can do that, correctly. So it's best to avoid it. The fifth investing mistake is don't invest without taking into consideration your goals, time horizon, and risk appetite. And finally, the sixth mistake is don't add new funds to your portfolio unless they truly provide diversification. Look at the investment objective of the fund and whether it's truly adding value to your portfolio. With that, we come to the end of this episode, and thanks Lisa once again for really helping our listeners understand this topic in a better way, and we'll catch you in the next episode soon.
Thank you, Ravi. Talking about investing mistakes is really the step one for everyone to begin, because we want to avoid the mistakes for better investment experience. So I'm really glad that we spoke about some of these things today, and I do look forward to the next episode and our next conversation.
Well, I know that I learned something new through today's conversations. I'm a very eager investor. I'm someone who actually enjoys it. And that being said, I'm also early on in my investing journey, much like many of you who are probably listening to our podcast series. And for that reason, today's conversation proved very useful. Some tips and insights there that I did not even think about. Thank you so much, everyone, for tuning into this episode of PGIM India Mutual Fund presents Smart Investing. This is Mia Halia signing off. Until the next time, happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
You are listening to the Smart Investing Podcast, brought to you by Money and Me, an investor education and awareness initiative by PGIM India Mutual Fund.